Welcome to The Explainer. Today, we are diving deep into the RBI's latest developmental and regulatory policies. Now, if you're preparing for any competitive exams in India, listen up, because this document, it's an absolute goldmine of potential questions, and we're going to break it all down for you. So how exactly does a central bank steer an economy with over 1.4 billion people? Well, the answer lies in powerful policy statements, just like this one. And trust me, this is not just some dry, dusty document. Nope. This is the playbook, the rulebook, that literally affects everything, from the interest you earn on your savings account all the way to the huge loans that build our biggest companies. So yeah, let's get into it. Okay, here's how we're going to tackle this. We'll break it down into 4 main sections. First, how we're fortifying our banking system. Then we'll look at simplifying global trade. After that, it's all about protecting you, the consumer. And finally, we'll touch on innovations in our financial markets. And stick around, because at the end, I've got a key exam takeaway slide that pulls everything together.
All right, first up, fortifying the banking system. Let's talk about the key regulatory updates. Now, think of these regulations as the shock absorbers for our entire economy. The RBI is rolling out new rules here, and the whole point is to make our banks safer, way more resilient, and, right up there with the best international standards.
Okay, the single biggest change, and this is a term you absolutely have to burn into your memory for exams, is the move to something called the Expected Credit Loss Framework. Just remember the letters ECL. This isn't just a small tweak, it's a complete game changer in how banks think about and prepare for risk. So what does that actually mean? Well, here's the core idea. We're shifting from being reactive to being proactive. See, the old way, the incurred loss model, was all about waiting. A bank would only set money aside, make a provision, after a loan went bad. But now, with ECL, they have to be fortune tellers. They have to look into the future, anticipate potential losses, and get ready for them right now, today. It's a massive shift from simple damage control to smart risk prevention. And this whole ECL thing is part of a bigger picture. It aligns India with the latest global standards, specifically the Basel III norms. What does that mean for us? In simple terms, it just means the math our banks use to figure out how much cash they need to keep on hand is getting a lot smarter and more realistic. It's more sensitive to actual risk, and that, at the end of the day, makes our entire banking system a whole lot stronger. Okay, check this out. See this number? 12 paise for every 100 rupees. Right now, that's the flat fee that every single bank in India pays for deposit insurance. It doesn't matter if you're the safest, most well-run bank on the planet or, well, one that's a bit more risky. Everyone pays the same rate to the DICGC, the Deposit Insurance and Credit Guarantee Corporation. Well, guess what? That one-size-fits-all approach is getting thrown out the window. The RBI is bringing in a new risk-based premium model. And think about what that means. For the first time, safer, better-managed banks are actually going to pay less for their deposit insurance. It's a really smart move, right? It creates a direct financial incentive for every bank to get its act together and manage risk more effectively. And look, these changes aren't just about playing defense and being super safe. The RBI is also playing offense. They're loosening the rules on how much banks can lend to the capital markets. We're talking about things like letting banks finance corporate takeovers, upping the lending limits against shares and other instruments like REITs and InvITs. The big picture here? This could pump a whole lot more money into the market, which could seriously boost investment and all sorts of corporate activity. Okay, so we've covered the banks. Now let's switch gears and talk about global trade. Section 2 is all about how these new policies are going to make life easier for Indian businesses that trade with the rest of the world. All right, here's a really simple but super important change for exporters. If you're an exporter with a foreign currency account in India's ISFC, you used to have just 1 month to bring your earnings back into the country. Well, that deadline has now been tripled. You've got 3 months. It might sound small, but for a business, that extra time means a ton more flexibility in managing their cash flow. Now, this next one is a huge win for the whole ease of doing business initiative. You know all that complicated paperwork that small traders had to do to reconcile every single export or import bill? Well, for any bill up to 10 lakh rupees, that's gone. Poof. Now, all they need is a simple self-declaration. This is a massive relief, cutting down on red tape and the compliance headaches for so many small businesses. Okay, next up, let's talk about borrowing money from other countries. There's a whole framework for this called External Commercial Borrowings, or ECBs. Basically, it's the rulebook for how Indian companies can get funding from abroad. And that rulebook is getting a complete rewrite. The goal is super clear. Make the whole process simpler, cut out the complexity, and make it way easier for Indian firms to access all that global capital out there.
All right, we've talked about banks and global trade. Now for Section 3. And this one is really important because it's all about protecting the most crucial part of the entire financial system, and that's you, the consumer. So, you know that internal ombudsman, the person inside a bank or financial company who's supposed to be your first stop for complaints? Well, they're about to get a whole lot more powerful. We're talking about giving them real teeth, like the power to actually award you compensation and the ability to talk to you directly. The idea is to make that first step of complaining inside the company actually mean something, to make it faster and a lot more effective. And this is huge, absolutely huge. The RBI's main complaint system, the Integrated Ombudsman Scheme, is expanding its safety net. For the very first time, it's going to cover customers of state and district central cooperative banks. This brings millions of people, many in rural areas, under the RBI's direct protection. It gives them access to a powerful and, importantly, free and efficient way to get their problems solved. And that brings us to our final section, innovating our financial markets. This is where we look at the really forward-thinking stuff, policies designed to deepen our markets and, really importantly, to start giving the Indian rupee a much bigger role on the global stage. Now, this is a very careful, very strategic move towards what's called the internationalization of the rupee. So what's happening? Indian banks can now start lending money in Indian rupees to companies and people in Bhutan, Nepal, and Sri Lanka. It's a first step, but it's a big one. It makes our currency more available in the region and encourages our neighbors to trade with us using our own currencies, not just the US dollar. And to make holding on to those rupees even more tempting, the RBI is sweetening the deal. So there are these special accounts called SRVAs, Special Rupee Vostro Accounts. Before, if a foreign entity had a surplus of rupees in one of these accounts, they could basically only invest it in government bonds. Pretty limited, right? Well, now they can also invest in corporate bonds and commercial papers. That is a massive incentive. It encourages them not just to hold our currency, but to actually invest it and use it within our economy. Whew, okay, we have covered a ton of ground. So now, let's boil it all down to the absolute essentials. This is your exam cheat sheet. For everyone out there studying, get ready to take a screenshot, because this is the slide you're going to want to remember. All right, let's run through this one more time. The key takeaways. First, expected credit loss, or ECL. That means proactive, not reactive provisioning for loans. Second, Basel III. That's all about stronger capital rules for banks. Third, the new risk-based premium for deposit insurance, which means safer banks pay less. Fourth, for small exporters, remember that magic number for simplified rules, 10 lakh rupees. Fifth, for INR internationalization, it's all about cross-border lending in rupees and opening up more investment options for those SRVA accounts. And finally, for consumer protection, the big news is the Ombudsman Scheme now covers rural co-op banks. Got it? Good. So, when you put all of these pieces together, it's clear this isn't just about minor tweaks here and there. No, this is about laying a completely new foundation, a foundation for a banking system that's stronger and a rupee that has a much bigger role in the world. Which leaves us with the really big question, right? With this powerful new foundation in place, what's the next big leap for the Indian economy?